Welcome, everyone. This is part of the educational outreach panel for COVID-19 for the St. Thomas University Center for Pandemic Disaster and Quarantine. Uh, this is effectively a center. It's a research hub that will serve to provide studies on pandemics, disasters, and help model and predict how institutions, companies, cities, counties, states, and nations can better prepare and understand the far-reaching effects of these occurrences in our communities. With great gratitude, we give thanks to Miami-Dade County for providing the funding to this center. And with that, I introduce to you Professor Mark Wolf.
It's my pleasure to be with you all today. And the first thing I'd like to do is also add my thanks to Miami-Dade County for providing the grant to St. Thomas University Center for Pandemic Disaster and Quarantine for these important educational outreach programs and all the other research work that's going to be done through this innovative center. I'd like to introduce to you today our topic is going to be the CARES Act. In particular, we're going to focus in on the Payroll Protection Program, and it's a loan program with forgiveness. So I'd like to introduce to you our panelists today. Let me introduce first David Bauer. David is an alum of St. Thomas University College of Law. After graduating from St. Thomas, where he received his Juris Doctorate degree and was awarded the tax law certificate, he attended a graduate tax program at New York University Graduate Law School, where he received his LLM in taxation. He's been an adjunct professor at St. Thomas College of Law, teaching various courses, including estate and gift tax, corporate tax, and federal income tax. I very much enjoyed teaching with David over the years. He's currently the managing partner of his own firm, Bauer, Gutierrez, and Bourbon, where he focuses on transactional law, specifically in the areas of tax planning, real estate, corporate and estate planning. Thank you very much, David, for being with us today. Second, I'd like to introduce to you a person who spoke first, Professor Francois Blanco. Francois Blanco, also an alumni of St. Thomas University College of Law. And upon his graduation, he also received his tax law certificate and went on to graduate law school at the University of Florida College of Law, where he received his LLM in taxation. After practicing tax law in South Florida for about 7 years, he was appointed an assistant professor and the director, and he also directs the St. Thomas University College of Law Tax Law Clinic. Assistant Professor Blanco supervises tax law students in the tax clinic that assist low-income taxpayers with representation before the Internal Revenue Service and the tax court. So without further ado, I'm going to jump right in and talk a little bit about the CARES Act. So let me. The CARES Act was passed into law as Public Law 116-136 on March 27, 2020, as part of the Coronavirus Aid, Relief, and Economic Security Act. That's the letters for CARES. The act was intended to provide economic relief to small businesses nationwide adversely impacted under the coronavirus 2019 pandemic, pursuant to emergency declaration executive order issued by President Trump on March 13th, 2020. Very importantly, Section 1102 of the CARES Act adds a new loan under the auspices of the U.S. Small Business Administration, Section 7A loan program, known as the Paycheck Protection Program. In addition, Section 1106 of the Act provides for forgiveness of up to the full principal amount of the qualifying loans guaranteed under the Paycheck Protection Program. Congress created the PPP, I'm going to refer to it as that, Payroll Protection Program, PPP, as part of a $2 trillion CARES Act funding. The legislation authorized the Treasury to use the SBA's 7A Small Business Lending Program to fund these forgivable loans of up to $10 million per borrower, and qualifying business could spend to cover on payroll, mortgage interest, rent, and utilities. Initially, a borrower is eligible for the PPP loan if the borrower has 500 or fewer employees whose principal place of residence is in the United States, or there are businesses that operate in certain particular industries and meet the applicable SBA employee base size standards for that particular industry. In addition, the borrower must be a small business concern as defined in Section 3 of the Small Business Act, 15 USC 632, and subject to the SBA's affiliation rules under 13 CFR 121.301 subpart F. You have to be in operation, the borrower would have to be in operation on February 15th, 2020, and either had employees for whom the borrower paid salaries and payroll taxes or paid independent contractors as reported on Forms 1099 miscellaneous. Also eligible for PPP loans are individuals who operate under a sole proprietorship or as an independent contractor or eligible a self-employed operation. Under PPP, the maximum loan amount is the lesser of 10 million or an amount calculated using the payroll-based formula specified in the Act. That formula is calculated as follows. Step 1, aggregate the payroll costs from the last 12 months for employees whose principal place of residence is the United States. Step 2, subtract any compensation paid to an employee in excess of an annual salary of $100,000 and or any amounts paid to an independent contractor or sole proprietor in excess of $100,000 per year. Step 3, calculate the average monthly payroll cost, divide the amount from step 2 by 12, and step 4, multiply the average monthly payroll cost from step 3 by 2.5. And finally, step 5, add the outstanding amount of any economic injury disaster loan, EIDLs, which we're going to hear about from Professor Blanco, made between January 31, 2020 and April 3rd, 2020, less the amount of any advance under the EIDL COVID-19 loan program. What kind of costs qualify that you can, spend the loan on in order to get forgiveness? That's important. Payroll costs. Payroll costs, compensation of employment to employees whose principal place of residence is the United States in the form of salaries, wages, commissions, or similar compensation, cash tips, or the equivalent. And the estimate of those cash tips could be based on the employer's records. In the absence of records, a reasonable good faith employer estimate would be accepted. Payment for vacation, parental, family, medical, or sick leave also allowed. Allowances for separation or dismissal. Payments for provisions of employee benefits consisting of group health care coverage, including insurance premiums and retirement. Payment of state and local taxes assessed on compensation of employees, and for an independent contractor or sole proprietor, wages, commissions, income, or net earnings from self-employment or similar compensation. The maturity date was 2 years in the original legislation. Repayment, a borrowed, if you took a PPP loan, you did not have to make any payments on principal or interest for 6 months from the date of disbursement. However, interest would accrue during the 6-month deferment period at 1%, very reasonable. The act also authorized to defer payments up to 1 year. Forgiveness. The amount of the loan forgiven can be up to the full principal amount of the loan and any accrued interest. Eligibility for loan forgiveness. To qualify for loan forgiveness, the borrower must use the PPP loan proceeds in the 8-week period that was under the original legislation, known as the covered period, following the date of the loan as follows. 1, at least 75% of the PPP loan proceeds were to be used for payroll costs. The borrower will have to document the proceeds used for payroll costs in order to determine the amount of the forgiveness. The remaining 25% of the PPP loan proceeds could be used for qualified business expenses, QBE. They would be costs related to the continuation of group health care benefits during periods of paid sick, medical, or family leave, and insurance premiums. Mortgage interest payments, but not mortgage prepayments or principal payments, just the interest. Rent payments, utility payments, interest payments on any other debt obligations that were incurred before February 15th, 2020. On June 5th, 2020, President Trump signed an amendment to the CARES Act in an act known as the Paycheck Protection Program Flexibility Act, sometimes referred to as PPP Flexibility Act. And that act, of course, amended a number of provisions of the PPP loan program and the forgiveness program. Those amendments related to maturity. So for new loans, the maturity period was to become 5 years compared to the original 2-year term established in the original legislation. This applies to loans obtained after the passage of the PPP Flexibility Act, June 5th, 2020, but borrowers and lenders could agree to extend the terms of any loan made before June 5th, 2020. It also changed the covered period. Current PPP borrowers could choose to extend the 8-week period to 24 weeks, or they can keep the original 8-week period. New PPP borrowers will have, of course, the 24-week covered time, but the covered period cannot go beyond December 31, 2020. This flexibility was designed to make it easier for more borrowers to reach full or almost full forgiveness of their loans at the end. The remaining 40%, so it was reduced from 75 to 60%, the portion that had to be used on salaries. And the remaining 40% could be used for qualified business expenses to qualify for loan forgiveness. However, a borrower would only be allowed to be forgiven up to the amount used for the qualified business expenses, subject to meeting first the 60% requirement that they use 60% of the loan proceeds on payroll costs. And so those were the amendments under the Flexibility Act. The other thing I'd like to talk a little bit about is that many people, I think, are probably paying pretty good attention to this, that there's obviously a number of proposals to extend this COVID relief for small businesses and to individuals. This is the debate in Congress right now. There's actually 3 proposals as of today. I don't know how many there'll be as of tomorrow, but as of today, there's 3. The first is the Senate GOP proposal, which basically rescinds the $429 billion of unused lending facility funds and repurposes $140 billion in CARES small business funding. It also includes limited liability for COVID related claims. Let me just get the next slide here. Yeah. Limited liability for COVID related claims. This is obviously a somewhat controversial proposal. 1-month extension of pandemic unemployment assistance to January 2021. The Continuing Paycheck Protection Program Act would provide additional assistance to the hardest hit small businesses that are struggling to recover from the impacts of COVID-19. Paycheck Protection Program second draw loans. It also establishes a second round of PPP loans for eligible businesses, defines eligibility for second PPP loans as a small business that meets the applicable SBA revenue size standard, has no more than 300 employees, so reduced from 500 to 300 employees, excuse me, and demonstrate, the borrower has to demonstrate that at least 25% reduction in gross revenues between comparison quarters in 2019 and 2020. So that's also a new requirement that they have to show a 25%, at least under this proposal, reduction in revenues. It includes set-asides to support first-time PPP borrowers with 10 or fewer employees, second-time PPP borrowers with 10 or few employees, first-time PPP borrowers who have been made newly eligible, and second-time returning PPP borrowers. Additionally, it provides for a set-aside for loans made by community lenders. The maximum loan size is up to 2 million, so reduced from 10 to 2 million, would equal 2.5 times the average total monthly payroll costs, plus up to $50,000 for covered worker protection expenditures incurred or paid by the eligible recipient during the period beginning March 1, 2020, and ending on the date of the enactment of the act. The 60/40 cost allocation for payroll and non-payroll costs to receive full PPP forgiveness continues in this proposal. The Paycheck Protection Program improvements, it expands forgivable expenses to include covered supplier costs, covered worker protection expenditures, and covered operation expenditures. So the qualified business expenses has been or at least expanded in this proposal. Allows borrowers to select a loan forgiveness covered period between 8 weeks and 24 weeks, during which to spend the loan proceeds on forgivable costs. So that remains the same as under the Flexibility Act, which modified the original CARES Act. Simplifies the forgiveness application process for smaller loans of up to 150, while increasing SBA's ability to audit and review these forgiven loans. The act also appropriates $50 million to support this audit function. Defines a seasonal employee, eliminates the requirement that the EIDL advances be subtracted from the PPP forgiveness, and establishes a procedure in bankruptcy process if the administrator determines certain companies in Chapter 11 are eligible for PPP loans. Estimated cost of the proposal is $332.7 billion, of which $257.7 billion is for Paycheck Protection Program second draw loans, an additional $20 billion in the cost of PPP to reduce the revenue loss threshold under which businesses are eligible for PPP, an additional $40 billion in the cost of PPP to increase PPP loan amounts by amounts spent by businesses on covered worker protection expenditures in order to help frontline sectors like restaurants and personal service industries. $15 billion for the grant program for shuttered venues. There's two other proposals. I'm running out of time, so I'm not going to go into them. Maybe we'll get to them when we do our panel discussion. But just so you know, the second one is, of course, by a group of legislators in the Congress and the Senate, referred to as the problem solvers. And it's a bipartisan group. And they've proposed a $908 billion, of which approximately that $908 billion, about 68% is basically repurposed from the original CARES Act legislation. So people should be careful when they hear that number of $908 billion. It's not new money. About 68% of it is carried over actually from the original CARES Act appropriation. And then finally, there's a third one. It's the Trump administration's proposal. It's $916 billion. And as I said, I'm out of time, but we can maybe talk about it when we turn to the panel discussion. I'd like to turn now to David Bauer, for his presentation. Mr. Bauer?
Thank you for the introduction, Professor Wolf. Obviously, he laid out a good synopsis of the CARES Act in general and the application process. I'm here to provide some more guidance on the PPP forgiveness process and some of the different elements that have come into play over the last few months. The main thing that's obviously been provided is the applications involving forgiveness. And they all are Form 3508, but there are 3 different versions. Form 3508S is allowed for any borrower with loan amounts equal to or less than $50,000. It's meant to obviously be an expedited application process for some of the smaller loan amounts, which in general tends to be, I think, the larger percentage of the total PPP loans out. The second form is Form 3508 Easy. You have to meet one of 3 qualifications for that form to be used. The first qualification is you have to be self-employed. Second qualification has to be no reduction in salary by more than 25% and no reduction of full-time employees. The third qualification allows a little bit more flexibility, but again, you have to have no reduction of salary by more than 25%. But in that situation, you are allowed to have a reduction of full-time employees, but you have to prove that your company was not operable during the period due to some government restrictions related to COVID. The final form is the generic form, Form 3508. This is the general application where you do have reductions of full-time employees and you do have reductions of salary by more than 25%. Obviously, as many of you know, when it comes to the PPP loan, the initial loan amount was based on a 10-week loan amount. And it initially was supposed to be a term of 8 weeks, but about halfway through the process, they allowed the term to be changed from 8 weeks to 24 weeks. However, we still have reductions in forgiveness amount related to reducing full-time employees or in reducing salaries by more than 25%. Going into what is a full-time employee, because that is obviously kind of the magic question. A full-time employee is obviously deemed as any employee who works 40 hours a week, and that counts as 1. So if you have an employee that works 30 hours a week, they're obviously allowed to count as a partial as 0.75. If you have other part-time employees and don't wish to get involved in the calculations of determining each of their percentages, there is a safe harbor that allows you to treat the part-time employees as 0.5. Once you determine full-time employees, now we need to obviously figure out what the reduction of your forgiveness is based on you reducing your full-time employees. We start with a full-time employee reference period. They allow, again, 3 options for you to be able to determine how many full-time employees. One, you could take the total amount of full-time employees from February 15th, 2019 to June 30th, 2019, or you can use full-time employees from January 1st, 2020 to February 29th, 2020. The idea being is obviously there's a lot of borrowers who had companies that were either started at the end of 2019 or maybe even at the very beginning of 2020. So that's why the second period is allowed. Seasonal businesses, they also allow a little bit of flexibility there. You're allowed to essentially use any 12-week period you want from May 1st, 2019 to September 15, 2019. These are in cases of holiday-related businesses or businesses that are very motivated or higher employee counts during different seasonal periods. Once you determine your full-time employee covered period, reference period, you then need to determine your full-time employee covered period. This is obviously either the 8-week period after the loan was funded or a 24-week period after the loan was funded. Once we have those 2 numbers, we can get into the calculations and formulas related to the reduction of forgiveness. The basic formula is full-time employee reference period divided by full-time employee covered period gives you your forgiveness ratio. You then take that forgiveness ratio and you take allowable payroll expenses plus allowable non-payroll expenses minus a reduction for any reductions in payroll in excess of 75%, times your forgiveness ratio gives you the amount disallowed as forgivable. This is a formula that you have to do, obviously, for all of your employees. But I will say that if you are choosing the 24-week period, I definitely do not feel that this formula deducts too much for the possible forgiveness applications, because now you're allowed a 24-week period of payroll expenses, despite a loan amount still being only 10 weeks. This is how you calculate the forgiveness reduction when it comes to reducing full-time employees. The next reduction or calculation you have to do is for employers who have reduced payroll of individuals by more than 25%. You're allowed to reduce payroll by up to 25%, but once you start reducing it by more than 25%, they are going to also disallow certain percentages related to forgiveness. Now, in this situation, you have to do this calculation per employee. So obviously, you're looking for payroll ledgers, 940s, 941s. A lot of the big payroll companies, Paychex, ATP, and Intuit, have actually been providing reports themselves based on the payroll that you run through those companies. I would start with that as an initial standing and obviously get either a qualified CPA or a tax attorney to review it, because I have noticed in some cases that they're a little off in some of their numbers. In this situation, same thing. You got to determine your reference period and you got to determine your covered period. In the reference period, you need to determine the annual salary, right? Because all of the formulas are based off of an annual salary. So for the reference period that you chose, you're just grossing up their annual salary based on that reference period. Meaning, if you chose a reference period that was 12 weeks, whatever that salary was during the 12 weeks, divide by 12, multiply it times 52, and you end up with their projected annual salary. For the covered period, same thing, right? If you're looking at a 24-week period and you determine that their salary was X over 24 weeks, divide by 24, multiply by 52, and you'll get their projected annual salary during the covered period. Now we get the formulas. So the reference period salary times 0.75 minus covered period salary gives you your forgiveness reduction per employee. Like I said, the calculation must be done per employee. And as you can see, that's built into the formula. They're already allowing a reduction of 25%, hence the 0.75 in the formula. So it really doesn't start to affect you until you reduce salary below 75%, by more than 25%, essentially. This is a synopsis on forgiveness, and I'll go ahead and let Francois take it from here.
Thanks, David. And thank you, Professor Wolf, with respect to the introduction. I'll be discussing the economic injury disaster loans, also known as the EIDL loans. As Professor Wolf previously mentioned, these EIDL loans were part of the 2020 CARES Act, which was instituted by Congress as a response to the COVID-19 pandemic. The EIDL loans are effectively a method to provide small businesses with opportunities and funding for the employment and general operating costs. Generally, as a general overview, the EIDL loans provide up to a $2 million loan with a term period of 30 years that can be used to pay for expenses such as working capital needs, payroll, and general operating expenses. These loans are provided at a 3.75% interest rate for businesses and a 2.75% rate for nonprofits. For the first year of these EIDL loans, they do have a 1-year deferment where payment is not necessary, but interest does accrue during that period. And these EIDL loans are available up to December 21st, 2020. Now, the program itself is divided into two parts. The EIDL loans are composed of the first part being the advance loans or advance payments, and then the second part being the actual main loan. Initially, when this program was released, you can go to the SBA and could have requested an advance payment of $10,000, which would have effectively provided you with a payment of $1,000 per employee. This advance loan was treated as a grant from the SBA and therefore did not necessarily require repayment as long as that payment was made for specific expenses such as payroll, sick leave, increased production costs due or caused by COVID-19 related supply chain disruptions, and other obligations in a business such as rent, mortgage, or other debts. As of July 11th, 2020, the SBA announced that all funds allocated for the EIDL advance payments have been effectively depleted and they're no longer available. However, the second component, they become important in the sense of forgiveness because they come in line with the computation of how they're forgiven under the PPP forms, as Mr. David Bauer had previously mentioned. Eligibility for the loan requires that businesses have 500 employees or less. They can be sole proprietors. It can be independent contractors. It could be cooperatives, employee-owned businesses, tribal businesses, agricultural enterprise, and actually not private nonprofit organizations that meet the nonprofit classification as provided in Section 501C. This program is a little bit more expansive than the PPP in terms of the actual type of businesses that can receive these type of loans. Forgiveness of the EIDL. So this is a loan from the government. It's a low interest loan. It is to the extent that we are looking at the main component of the loan that is not forgivable, that needs to be repaid, except for the exception that if you received an EIDL loan between January 31st, 2020 and April 3rd, 2020, and you apply for a PPP loan, and then you refinance your EIDL loan into the PPP loan, you can essentially have your EIDL loan forgiven. This only applies if you received the EIDL loan prior to April 3rd. If you received it after that, it does not apply to you. And this was a method when you refinance your EIDL into your PPP, you effectively have taken PPP loans and you're under the whole PPP regime in and of itself. That's with respect to the main loan. With respect to the advance payment, that advance payment, as previously mentioned, can only be repaid, can only be forgiven if it is done to if it's used to pay leave for employees, maintain payroll, pay for increased cost, mortgage payments, lease payments, and actually any obligation. It's a bit more expansive as compared to the PPP loan, which requires you to be very restrictive in terms of it being paid just to employees. The EIDL loans can be used as a way to finance and continue your operations. The way that you can apply is effectively online. That's the only way available, which is at www.sba.gov/disaster. You can call or you can submit an email. However, the best way, they're going to direct you to do it online. If you get denied, you get 6 months to reapply with a written reconsideration. And if you get denied again, you have 30 days to appeal. The application process is actually very simplified. As you'll see, you go through a 5-step where you provide disclosures, where disclosures are made to you. You provide information with respect to your business, with respect to the owners. You give a little bit more information in terms of tax information associated, and then you have a summary and you get submitted. Part of the disclosures are verifying that you have been subject to some sort of financial detriment or financial injury due to COVID-19. So that is a disclosure that you effectively needs to be done. If you're taking these loans out for any other reason other than that, or you're not subject to it, you run a potential risk of having a liability with the government in terms of repaying back these loans and actually requesting for it. And the process itself is simple. You identify or verify where your entity falls under. You review that you haven't been engaging in any illegal activities, that your ownership is greater than 50%, and that there's certain restrictions in terms of it not being associated with gambling activities or lobbying activities, or that you're trying to effectively have in some sort of way your operations your operations have to do with some sort of, let's say, the sale of products or service or the presentation of any depictions or display of a prurient sexual nature. And the process, it's simple. You prepare your business legal name, the trade name. You need to have the employer identification number for your entity. This is not necessary if you're self-employed. It is useful, but it's not necessary. You would just use your own personal name in that capacity. And you identify whether you're a nonprofit organization or whether you're a franchise. Part of this application, you need to provide what your gross revenues were during that time period, so you have an idea, so that they have an idea in terms of how much can be lent. Additionally to that, you provide contact information as well as a detailed summary of your business activity. So that is a summary of the idle loans in general. I'm going to pass it back to Mr. David Bauer, who's going to explain about the tax consequences associated with the PPP loans. David?
Thank you, Francois. What seems to be a very hot topic nowadays, obviously, is the tax consequences related to the PPP loan. The IRS and the legislation's already obviously ruled that the forgiveness of the loan itself is not income to the taxpayer. This obviously is a little different than normal tax law because of cancellation of indebtedness income. But nonetheless, they've given that as a benefit to borrowers who are taking the PPP loan, that they do not have to pay taxes on the forgivable portion. There is a question regarding the deductions related to expenses that you use the forgivable money for. Currently, I think that's one of the more hotter topics. There's a lot of tax practitioners on both sides of the aisle, but currently the legislative branch has taken the position that whatever forgivable money you use towards operating expenses are not considered deductions to the taxpayer in that tax year. Now, as specifically as the timing, when I mentioned in that tax year, for a little bit, there were some questions as to, well, what if I get the loan forgiven in 2021? Am I allowed essentially to take the deductions in 2020 with an offsetting adjustment for 2021? Because we know that most of the forgiveness applications really, there has been some, but there are many that have not been done and don't look like they will be completed till 2021. The IRS did issue Revenue Ruling 2020-27 and basically laid out two situations. One where the taxpayer does submit an application prior in 2020, but will likely not be given forgiveness until 2021. And another situation where the taxpayer does not plan to apply for forgiveness until 2021. They have made it clear that if the taxpayer has a reasonable belief and expects to receive forgiveness as to any portion of the loan or the entirety of the loan, you are still not allowed to play with the timing and thus take deductions in 2020. So in all cases, if you have that reasonable belief, they will disallow all deductions related to expenses of which you use the forgivable portion of the PPP loan. I do know, as many of you will know, that we have, every week it changes. We have new rules, we have new guidance that comes out. And this is definitely one of the hotter topics that a lot of tax practitioners are trying to aggressively lobby legislation or the IRS to change their mind on and allow these expenses. Personally, I don't believe that that'll happen because it's pretty consistent with general tax law, but stay tuned. I will circle back to Professor Wolf now and let him take it from here.
Well, this is kind of an interesting topic, David. They also made a section 265 argument in notice 2020-32 and in revenue ruling 2020-27, which if you take a look at it in depth, the 265 argument can be really taken apart pretty effectively. But I have to say that, in the original act, the CARES Act, right now the section eludes me, I think it was 1106. It specifically says that the forgiveness of the loan is not taxable income. Yeah, 1106. So that's right in the CARES Act. So the IRS can't do much about that. And I'm guessing that that's why they, address the deductions as opposed to the forgiveness, because the forgiveness is statutorily included in the Act in section 1106. To me, it seems to me that if you get tax-free money, if you get a loan that's forgiven, that it's a little bit difficult, at least for me as an academic, to argue that you ought to also be able to get a deduction. It seems like you're taking two dips at the trough, okay? Not only you're not having taxable income, but you're also going to take a double deduction, so you're doubling up. But, certainly, I think this is going to be, as you said, a very, very hot issue. And I don't think, I haven't seen in any of the proposals that I was talking about before, that are pending in Congress. I haven't seen anything on that. It seems that the big fight with those proposals are certain types of expense, categories that people are unhappy with. So, for example, giving kind of blanket immunity to corporations who don't take reasonable efforts to protect either employees or customers from the COVID-19 virus. And that if it's contained certainly in the GOP Senate bill, and it's a very broad application of immunity from any kind of lawsuit. So this seems to be controversial. I mean, it's not where they're fighting about the money, but it's a big area as to whether or not this would disincentivize corporations from taking reasonable approaches to protect employees or customers in their course of business from contacting COVID-19. I don't know what you all think about that, but that seems to be a big bone of contention right now.
I would agree. I think from the first round, it was clearly that Congress learned its lesson that there were many big businesses that abused the ability to take out these PPP loans and effectively maybe not use them for the purpose of paying out employees. An argument that goes around is that at one point or another they were used anyways. So it was if it's not the employees, it's someone else who has some sort of business going in. But regardless, there is a specific objective with these loans, and I think Congress is trending along the lines that it's going to be a little bit more restrictive as to how this new round is going to go. Developments happen every day, and really things change. We have three proposals at the moment that all review that effectively you need to show that you were affected by COVID-19 based from prior quarterly earnings to current quarterly earnings. So I think we're definitely along that path where any proposal that comes through, businesses and owners and self-employed individuals need to be made aware that Congress is watching and closely looking at effectively how these loans are being used. And I would also rather to say that I think both, we have the three proposals effectively put out have competing, let's say, conditions associated to them, where we have some conditions based on the fact that it's based on putting teachers going back to school, children going back to school as well. So I think those are other conditions that we need to take a look at and see how that's going to be implemented and whether it's even feasible or given COVID-19 and all relating consequences of it, whether it's even safe to do so. But regardless, we can definitely anticipate that there's going to be more restrictive means on these loans.
Yeah. What about the provisions with regard to state, local, and includes tribal governments, but state and local governments that obviously have been their budgets pretty severely impacted by the COVID-19 pandemic. How about what do you think about appropriating money to help out the local governments in the second round?
Yeah, there are obviously a lot of states who need help. Some states more than others. And if everybody's been watching news, the governor of New York is very political in terms of making himself known and what he needs for his state. And I would agree. Obviously, New York's probably one of the hardest hit states in the entire country, just by terms of size and population. There hasn't been a lot of conversations, at least in Congress, in helping the states. So I'm not sure if I personally have not seen any of clauses that have been added to any of the proposals. I definitely think states do need some help. I think what people don't realize is that if you close down business in states, you are losing sales tax, you are losing revenue for the state. while at the same time asking that the state provide certain grants and support mechanisms to deal with the COVID. So not only do they have a reduction of the incoming money, but they have a huge increase in the outgoing money. The federal government has tried to assist in ways of PPE protection, and providing masks, providing different things for hospitals and support. They've also, in many ways, provided other guidance in terms of logistics support and in testing centers. But I haven't heard too much in the way of providing money other than in unemployment. All of the proposals obviously have some mechanism to extend the unemployment benefit, the other extra $600 that's been provided by the federal government. So the federal government has obviously helped states out from the increased amount of unemployment applications that have come into play. Like Francois had said, I think the overall theme that at least I see a lot in the new proposals is the requirement that you provide need. I think a lot of tax practitioners will agree the way it rolled out the first round of PPP, everybody in the news knows there are many businesses that, I'm not gonna say take advantage, but they did in a way. The idea was that you were supposed to certify that one, you needed the assistance, and that two, you did not have other alternatives in the public sector. For many of the companies that were very popular in the news for taking $2 million, they were publicly traded, or they were large sports organizations who obviously had the capability to take loans at more commercially reasonable rates in a public sector, a public financial situation. A lot of those companies did return the money, more, at least in my opinion, because of the bad backlash that came from the PR nightmare. But it still happened. And you're still now going to end up in a situation where I believe the second, third, whatever rounds come out of Congress at this point, you will have to prove need. And like Professor Wolf started off with, you will also have to prove that you are providing certain items or certain products to your employees to help with the spread of coronavirus, i.e. masks, the ability to work from home, the ability to have flexible schedules, testing, etc. There is obviously some conversations regarding moratoriums, rent moratoriums. There's a big hoopla about the CDC saying you couldn't foreclose on properties. I know that's big in every county in Florida. There are a lot of pending eviction cases that have been sitting here kind of on the docket that have kind of just started going about a month ago. I know courts in Florida are allowed to issue writ of possessions now. That was more because of Governor DeSantis removing the moratorium, and he was citing CDC. The problem is when federal government passes a bill of moratorium, if the governors don't come in and also agree with that on a state level, then it really only applies to properties that have federally backed mortgages. And from an eviction standpoint, this has been a hot topic in litigation for a lot of landlord-tenant attorneys in dealing with evictions. Obviously, this panel, we're sort of focusing on the loan aspect, the PPP, the EIDL, the second round, third round. Something's coming. I think we all agree on that. Whether or not it's going to happen before the new president-elect takes over or after, that's kind of, I think, a little bit more of a question. I think while the Republicans, obviously everybody's staring at Georgia and those 2 Senate seats, I think that will make Republicans a little bit more willing to play ball in the Senate and likely agree to get something passed before the new president-elect takes over, in hopes that it'll help boost the Republican vote in Georgia and the Senate seats. Those are my opinions. I'll let Professor Wolf take it from here.
Just one little comment. There is one of the proposals, the bipartisan proposal, from what they call the problem solvers, but it's bipartisan. It's got Republicans and Democrats, both from the House and the Senate. And it has a $160 billion for state and local and tribal governments. The other two, you're right, they have nothing for state and local governments. That's who knows what's going to happen with these proposals. That to spend a lot more time on them, I think what you say is correct. It's I think something's going to be coming, whether it comes now before the new administration takes over or comes afterwards. go ahead and flip a coin on that one. I'm hoping that something comes, because I know that so many people are in really grave need. And so it would be, I think, wonderful if the Congress could do something, because as I pointed out in the beginning, and I think it's worth mentioning again, about 68% of the money that they're talking about in any of these proposals is repurposed from the original appropriations in the CARES Act. It's not new money. It's not all new money. 60% of it, 68% of it is coming from money that was originally appropriated in the CARES Act. So, Francois?
Yeah, just a few points. Yeah, I definitely agree. I think I'm more that this is probably going to come into the new year. By the end of the year, I think that we have a lot of competing issues. We got the funding, we got a lockdown in terms of whether there's actually even financing. There's a few other congressional acts that may be taking way. But in terms of government of state level financing from the loans themselves, I think those two Georgia seats are going to definitely make a difference in terms of how much funding that is provided. I think the other thing is how well a state can self-sustain itself in that capacity. And recently, we've seen quite an exodus of residents, let's say, going from California to Texas and New York to Florida. So I think those are all competing factors to determine whether there's effectively going to be some sort of funding and financing for the states. Just to touch and regardless of that, I think it's a priority, but I don't think it's a large priority as it is providing some sort of financing for smaller businesses. So I can see it should be addressed, but I'm not too sure that might be a point of contention between the parties. With respect to just a few topics that David brought up, with respect to landlords, yeah, you are correct. If you have a federal loan, you are subject to not being able to evict your tenant. But I think there's quite a good set of people there who, let's say, don't have any mortgages on their homes and are currently not receiving rent. So I think those are also a good, group of people that are maybe putting pressure in terms of what is being done. So with that said, I don't anticipate anything to be passed before the end of the year. I think this might be something that maybe January, February of next year at the latest.
That may very well be where we're going. I'm just very concerned about the people out there that maybe can't make it until, January. But I think this is going to kind of conclude this educational outreach panel. Perhaps we want to, I don't know, Francois, if you want to give out some contact information, should someone have some questions of us or want to contact us at the university or at the PDQ?
Well, this was an interesting discussion in terms of the PPP and the EIDL loans and the forgiveness. Of course, that is the main method and purpose of the PDQ Center here at St. Thomas University, to address these issues and concerns for individuals. If you have any more questions, please feel free to get in contact with us. Our contact information will be provided at the end of this presentation. Thank you and have a good day.